Welcome to the August interest rates and values update. We have a lot of things we're going to cover today. As a summary, we're going to go over interest rates. It's hot. It's a hot topic. That's what I mentioned. When are rates going to come down? There was a little piece of news today by the Department of Treasury, and we're going to talk about it. We're going to go over all the different charts. What has, like, things like the Fed would look at, things that they would consider, things that go into whether interest rates will go up or go down, at least from the Fed perspective. There's some new rules relating to condos. You may not have known, but condominiums have a different type of approval process than a single family residence. And we're going to go over those, plus the new rules that went into effect this month. We're also going to go over refinancing. If rates are going to come down, when would be a good time to refinance? What are some things we should consider? And since a lot of people have a lot of equity in their homes, maybe consider lines of credit. We'll talk about it. And then we're going to talk about the Vantage credit score. So you may be familiar with FICO, but the lenders now are accepting Vantage as well. So there's two different scores, FICO or Vantage. Not every lender accepts Vantage yet, but we're going to be seeing more of those, and we're going to talk about that. And then finally, we're going to touch on AI. A lot of people like AI and think it's the solution to everything, but it just may not be the solution to everything. And we're going to talk about that too. So let's start off with the big news of today, interest rates. The Department of the Treasury said today they're going to double up the purchases of bonds from $2 billion to $4 billion starting next month, September 9th. What does that mean? The last time the Treasury has purchased lots of U.S. bonds, U.S. debt, was during COVID, and when they had quantitative easing to try to bring rates down. That's what's happening. So this is what has spurred that on. We're going to take a look at the 30-year bond. Okay, everybody see the 30-year bond?
Yes.
So here you are, the 30-year bond rate today was at 5.186. The markets had just closed here. We're in Arizona, so it's 1 o'clock our time, but 4 o'clock Eastern time. So the market's just closed. And so you can see that the 30-year bond peaked here in July. For the first time, it was at 5.282, and it hadn't reached that height since May of 2006, about 20 years ago. So the 30-year bond has reached a high, the highest it's been in about 20 years. The thing that we look at for mortgages is the 10-year bond. So the 10-year bond as you can see today, it was down on the news by 7 basis points to 4.633. And here it is. But it went as high as 4.747 in July. And that's as high as it's been since January of 2025. So it was the highest it's been in a couple of years. Well, the Feds have noticed this, and they said, hey, we got to do something. And that's why starting next month, you're going to start seeing purchases of U.S. debt by the Treasury. So what they're trying to do is they're trying to bring rates down. And the last time they did that was during, like I said, COVID. So we're going to see how that works. But let's take a look at some of the other data that they had to consider when they were trying to decide, hey, what should we be doing about the rates? Let's take a look at the Consumer Price Index. That's something that people usually always look to as a indicator for inflation. And the CPI, where'd it go? There it is. All right, here's a Consumer Price Index. And as you can see, and this is what it's been since 2006. It's kind of gone up and down. In 2022, it was at 9.1%. but then it came way down, way down, way down, way down. And then right around the beginning of this administration, it was about 3.1. And then when the Iran war started, see if we can zoom in on this. No, it shot up. It shot up to 4.2%. And now it's retraced a little bit to 3.4. So inflation kind of retraced a little bit. Let's take a look at, the personal consumption index. It's another index that's reviewed by the Fed when they are, and they actually like the personal consumption index even better than the CPI. The personal consumption index, as you can see here, does it pop up? Yep. Let me do this. So it has come up. It went up to a little over 4%, but then in the last reading in the last month, it came back down under 4%. So let's take a look at next. Let's take a look at oil. What's going on with oil? And the reason why I'm bringing up all these are all the different indicators that go into when the Fed tries to determine whether to increase or decrease the Fed funds rate. When people are trying to determine whether they're going to purchase mortgage-backed securities, they look at all of this data and trying to decide what they want, whether they want to buy these securities and what's going to happen with the rates. Today, oil ended up a little bit, 84.19. But as you can see here, right when the war started, it peaked at 112 in April, but then it came down as, sometimes there's a negotiation that it's going to, that we're done with the war. And then there's a memorandum of understanding that apparently expired yesterday. So there's all these different indicia, but they kind of keep it right around here. It's at about 84. So, looking at the CPI, looking at the PCE, looking at oil, none of those numbers seem all that off, right? Let's see. They're a little bit high, but you saw that they started coming down a little bit. Let's take a look at the next indicator, unemployment. Unemployment's really interesting. You take a look at unemployment. Here's what it looks like. It peaked, as you can see here, during COVID, which makes sense. It was at 14.8%, but then it came all the way down. And actually, in the last few months, it's actually come down even more, and we've got even a close-up of that. So here you can see in December, it was 4.4, but it's remained relatively steady. So people have been saying, so what's going to happen with mortgage rates? What's going to happen? Are mortgage rates going to go up? I get this question all the time. Are mortgage rates going to go up this year? Are they going to come down? When will they finally come down? There's a lot of data out there. And one of the reasons why the Fed didn't raise the Fed funds rate this last time is some of the data that I just showed you. That inflation and PCE and unemployment, they just came down just a little bit. The Fed, this particular Fed chair, wants to reduce rates. And they aren't. And so it's going to take a lot, even though in the last board meeting, a few of the board members voted to increase rates. But it's going to take a lot for the Fed to actually increase rates before I see that the Fed does any action as far as that goes. So let's take a look at one more chart I want to show you is mortgage rates, because that's what we've been talking about all along. And this is from Mortgage News Daily. This is mortgage rates, and there's three different indicia here. There's Mortgage News Daily is in the blue. The Mortgage Bankers Association is here in the purple or black. And then Freddie Mac is in the orange. Freddie Mac is down here in the orange. They all have different ways of analyzing the rates. The Mortgage Bankers Association is just that. It's bankers. It's not wholesale lenders. Freddie Mac is anybody who sells to Freddie. So it could be banks, it could be brokers, it could be anything. And their average rate is based on all the loans that come in, whether they're with points or not. They don't necessarily discern whether those are with points. And Mortgage News Daily does something more along the lines of quotes. They read the websites or whatever, and these are quotes. Nevertheless, all of them are up here in the 6.7, 6.73 range, which you can see is the highest rate it's been in over a year. So these are all the reasons why today's hot news is that the Fed is jumping in and the Fed wants to do something about rates. So panel, anything you guys want to comment on that, on interest rates? Anything you'd like to share? It's definitely something we've all been seeing, and we've been all watching them slightly go up and go up and go up. But it looks like, at this point, especially this morning, which is just coincidental because that was our podcast was today. They decided that they would go ahead and double up the purchase of U.S. Treasury bonds, which could have
that's not till September 9th.
So not so well, right? But the announcement today actually spurred some buying of the bonds, and that's why the yields came down.
Oh,
it'd be nice for some of these buyers to get off the ledge.
Yeah. Well, I mean, that's one of those things, Kirk. I mean, you can wait for rates to come down, but if you wait for rates to come down, what inventory is going to be available and at what price? Because when rates come down, there's going to be multiple buyers. And we experienced that just recently in COVID, where there were multiple buyers and it was hard to get a house and people were waiving appraisals. And some people even waived inspections, which was crazy. But that's what people were doing to get homes back then.
But what's nice is that with what's going on or what's coming out is that some of these people might start getting out there and looking now so that they can start looking for houses, knowing that maybe 6 months, 9 months down the road, a lot of people will be going out. Maybe they'll get a nice little price increase on the properties that they bought.
Yeah. That could be. That'd be good. That'd be good. So that's the market update. Any questions and anything before we move on? Because then we're going to go on to the hot topic, which is condos, which a lot of you out there don't even know that condominiums are looked at differently than single-family residences. In fact, when you purchase a condo, what you're purchasing is you're purchasing a unit. You may have shared walls, shared ceiling, common areas. You're purchasing an ownership in the common areas. There's a lot of you're purchasing an ownership in that association. And the lender wants to know more about that association before they're going to approve the loan. So what lenders ask HOAs to complete is something called a Condo Questionnaire. And here is the Fannie Mae's Condo Questionnaire. Let's pull that up. So if you're going to purchase a condo, the lender is going to have to fill out the HOA is going to fill out a form called a Condo Project Questionnaire. And this has to be reviewed by the lender, and it's got to meet Fannie and Freddie guidelines. Now, if it doesn't meet Fannie and Freddie guidelines, that doesn't mean that you can't get a loan. You may still be able to get a loan, but it won't be at necessarily the rates that you could get at Fannie or Freddie. It may be at higher rates. This is called, in the business, it's called warrantability. If it meets these guidelines, the loan is warrantable and they'll be able to sell it. If it doesn't meet the guidelines, it's non-warrantable. And there's a whole bunch of investors, including private money, that this doesn't really matter to, and they will go ahead and lend if it's non-warrantable. But let's kind of go through this checklist just so you can see the different things that lenders consider when they're considering lending on a condo. Here is the project 100% complete, including all construction or renovation of units, common elements and shared amenities for all project phases. That's something that's important before Fannie or Freddie will lend. Was there a conversion within the past 3 years of an existing structure that was used as an apartment, hotel, resort, retail, or professional business? Then they want the details on the conversion. How many unit owners are 68 more days delinquent on HOA? If there's too many delinquencies, Fannie and Freddie want nothing to do with that condominium association. In the event a lender acquires a unit due to foreclosure or deed in lieu of foreclosure, is the mortgagee responsible for paying delinquent common expense assessments, HOA assessments, HOA dues? Is there pending litigation? And then number of units sold and closed, because if any one person has more than 10% of the units, that could cause an issue with Fannie or Freddie. And there's also I'm giving you a little clue as some of the changes, a 50% investor requirement too.
It's now 50 instead of 60.
It was 50. Do the unit owners have sole ownership in and right to use the project? Are any of the units used for commercial space? Is this total square footage of commercial space in the building separate from residential HOA? So for example, in the upper units could all be HOA, but then in the first, you have a whole bunch of stores in the first unit. That would be an example of something like that. Flood insurance, flood zone. Remember those condo collapses in Florida several years ago? This part got added after that. Now they want to know about the safety, soundness, and structural integrity of the condominium association. This is something that actually, when this first came in, we had some resistance from HOAs of filling this out because they're like, we're not engineers. How can we opine on the structural integrity of a building? That's beyond our, that's beyond our scope. We can't do that. So what they tend to ask then is, when was the last building inspected by a licensed architect or engineer, trying to find when the last inspections were. And then are they aware of any, is the HOA aware of any deficiencies related to safety, soundness, structural integrity, or habitability? Are there any outstanding violations related to safety, soundness, or habitability? So in other words, they're getting to some of the violations, things that you wouldn't necessarily need an expert to opine on, but things of fact. Has there been a study done in the last 3 years regarding the structural integrity of the building? Also, here's another one. They'll ask for a reserve study. Has there been a reserve study completed in the project within the last 3 years? That goes to the financial viability of the condominium association. Any special assessments? They want to know that. So,
John, did they increase the reserves on condos?
They will, and I'm going to get to that in a second. That's one of the changes. Has the HOA obtained any loans to finance improvements or deferred maintenance? So right there, you've just seen a whole bunch of items that lenders look to determine whether they're going to lend on a condominium association or not. These are things that you may never even known were even an issue, but these are things that are looked at and considered by Fannie or Freddie as to whether they're going to lend. And that's something to know and keep in mind, because if you're purchasing a condominium association, you need to make sure that the condominium association is warrantable. And the best way to do that in the front end is if you're working with a real estate agent, they have access to MLS and they can search all the sales in that condominium association in the last 30 days, 60 days, 90 days, 6 months. And all the closed sales will show what type of financing was acquired, whether it was FHA, conventional, or cash. So they'll be able to tell exactly what type of financing, and if all those properties were purchased with cash in the last 6 months, there may be some issues about trying to get a mortgage loan through there. Now, if you're looking for an FHA or VA loan, those loans have to be on the FHA or VA condo approved list up front. So you need to talk to your lender and make sure those associations are approved up front. Now, effective this month are the changes that the FHFA, which is the Federal Housing Finance Agency, they made changes to condominium association approvals. And the biggest one in our world is that they got rid of the limited reviews. And that was a big to do, because that big questionnaire that we just went through, there used to be a process which was only like 1 page. And it was called a limited review. They only asked for certain items, not as extensive, and And if Fannie Mae or Freddie Mac's software would approve it, you just needed a limited review. You wouldn't have to go through that whole analysis. That's been eliminated. So now full reviews are with a full questionnaire are going to have to be completed. They are, however, retiring the investment property concentration limit of 50%. In other words, investors can own more than 50% in these condominium associations. That's a big one. Another one is property insurance must provide coverage on a replacement cost basis, except for roofs, which could still be actual cost value. So they're going to have to do replacement cost insurance now for HOAs because that's an issue with these big. They want to make sure that something happens that the HOA is insured, especially if you have a big condo collapsing in Florida. And then to the point that Kirk was referencing, beginning in January, the minimum reserves for capital an HOA budget increases from 10% to 15% of the annual budgeted income. That's not going to start till January. And I suspect the reason why they did that is they wanted everyone's fiscal year to complete. So people had time to budget that so that they would, when they're doing their forecasting and budgeting for the next year, they can go ahead and have time to do the 15%.
Hey, John, got a question for you. That's for condos, the reserves. What about for townhomes and patio homes? Have you heard anything on that?
No. These apply to condos.
Okay.
So, but that's a good point because some people will say, I'm buying a townhome. It's not a condo. So none of this stuff applies. And then we get the legal description, and the legal description says condominium association, even though it's called a townhome. So the legal description is what controls, and that's what the lenders look at. They'll look to see if the legal description says condominium or the terms horizontal regime. That's also something that triggers lenders to let them know that it's a condominium. So even though you think it's a patio home, there are single-family detached homes that have horizontal regime in the legal description that we've had to do condominium review on.
My son owns one.
Sorry?
My son owns one.
Yeah.
Right around the corner.
Yeah, they're out there.
Yeah.
And you're like, why? Why would a developer do that? Well, obviously there's some sort of financial benefit for them to do that and have the legal description as condominiums. Otherwise, they wouldn't have done that at all in the first place. But so those are the changes for condominiums. Those are things to keep in mind as to if you're purchasing a condominium. Panel, any questions, any comments on any of that? Anybody have any condominium experiences? Now, I know Alan does a lot of private money loans. So what I've just talked about for the last 15 minutes or something doesn't even apply to him.
We don't
Money
care.
lenders, they don't even look at any of this stuff.
Yeah, we wouldn't care. But I am curious about now that the form is a lot longer and more involved to fill out, what the condo association fee is going to go up to because their time that they have to deal with. How do you get rushes on it when you're trying to do a close of escrow? Those problems. And if you're dealing with a smaller condo association of maybe 10 units, 15 units, who would be in charge in filling that out, finding out who that person is out of that 15 units and how are you going to get them to fill it out as opposed to a larger complex that might be 300 units where you have some professional agency handling that for the condo association as opposed to the smaller complexes, which are individually, the residents are the ones they're handling it. They're on the board and they're handling that type of filling out that form, and how quick a response you're going to get out of those type of people may be problematic down the road.
I completely agree. And this was done with the purpose of understanding what of making sure that the condos are, lendable, marketable, whatever. But you're right, because you're going to have increased insurance, because you're going to have increased budget. HOA fees could go up. I completely agree with that assessment there, Alan. I think that's exactly what could happen is HOA fees could go up as a result of this.
Yeah, it's just even on the I heard something that the condo certifications now have been costing around $300.
Oh, they do. It's not even the cost of the condominium, the HOA cert, but that's right, because that's a good point. If you're purchasing a condo, you're gonna have to pay $300. And so a lot of people say, well, can't I find out ahead of time if the condominium association is approved before I even make an offer? Sure. You want to spend the $300 up front to get the HOA cert? That's what you're going to have to do because the HOAs aren't
Right.
going to give that information out.
Is that
They're
going to be,
charging a fee for it. If you want to pay the money to get the HOA cert, yeah, I can send it to a lender and they can review it. But
right,
then you've just spent $300 and you may not buy the place. So
right. And now I think with this new form, it'd probably be $400 now, because it's more involved.
yeah, well, the form's still the same. It was the all old full review form.
Oh,
Yeah.
okay. There's
So
not new.
that form we went over that form's been in place for a long time. So that hasn't
Oh,
changed.
okay. That hasn't
It's
changed.
just the latest things have changed with the insurance and
Oh,
the increase to the
okay.
reserves. But in our industry, there was a lot of pushback on getting rid of the limited review because as you could, we want to try to get these loans done quickly and go through
Yeah.
quickly. And if they get rid of limited review, that doesn't really help. And limited review is so much easier and quicker, but that's
Right.
gone.
Right.
So, okay, well, next topic is refinancing. So our friends over at the Wall Street Journal came out with a nice little article. Is it? Here it is. Where is it? Today's just one of those days. It's kind of hard to find these things. Okay, here it is. So here's their article. Their article is What to Know Before Doing a Cash Out Refinance on Your Home. This was a few weeks ago. And they talk about, if U.S. homeowners are sitting on an average of nearly $300,000 in home equity, according to the Federal Reserve, and many are deciding it's time to put some of that money to use. And they're saying, should you do a cash out refinance? Should you do a line of credit? How's best to try to do, to take advantage of that equity? And if you want to borrow from that equity. Well, as we saw earlier today, mortgage rates are in the high sixes. So if you have a 3% loan, you're really not inclined to do anything with that 3% loan. You may consider a line of credit. Okay, so if you get a line of credit, depending on how much equity you're doing and what your credit score is, that'll depend on what the rate is. Line of credit rates start off based on prime, which as we sit here today is at 6.75, plus a margin, depending on the amount of equity, your credit score, primary residence, second home, investment property, whatever it is, those are factors that go into determining the rate. So would it still, if you end up with a line of credit that's at 9%, is it better to refinance the first mortgage? Well, that gets into something that we'll talk about, and we've talked about in the past, which is called blended rate. And this is something that we did talk about in one of our prior podcasts. And here's just a little blended rate example. So in example A, you have 500,000 first mortgage at 3% and a 300,000 second mortgage at 8%. What is the blended rate? Well, it's a weighted average calculation. You take 500,000 at the 3%, 300,000 at the 8%, 15 and 24 respectively. You total that up. Then you take the total balances of the loans, and 39,000 divided by 800 is 4.875. So that would be the blended rate. So in that instance, yeah, you'd probably say, I don't want to get rid of my 3% mortgage. My blended rate's 4.875. Let's do the second mortgage at 8%. That sounds good. Now, let's say your first mortgage is a low balance at 200,000 and it's 3.5%. And the second mortgage is 300,000 and it's 8.5%. Then what happens? Well, doing the same calculation, boom, 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 blended rate 6.5%. Well, now, okay, well, what's today's mortgage rates? Well, they're a little bit higher than 6.5% right now. So maybe you're fine on doing a first and a second. But here's the other thing you should consider when you're trying to refinance. When you refinance, when you get that amortization schedule and it's part of your loan application documents, and you're trying to get a $300,000 loan, but there's $600,000 of interest you have to pay over 30 years, that starts all over when you refinance. So that's something you need to consider is that interest charge is going to start all over. So if you are looking to refinance and you're trying to get that, 6.75 or 6.875, whatever the rate is, you're going to start that amortization schedule all over again. You may end up lowering your payment, because, you may have a higher payment at a lower rate because of the amortization. So you could lower your payment. So there's a lot of different factors that go into whether you should refinance. And so it's just not one of these simple, and you hear it all the time. Oh yeah, we can get you a 6.5% rate. Okay, what are the costs? What are the fees? Oh yeah, we can do a no closing cost loan at 6.875. Okay, well, what could you do if I did pay costs? Maybe I get 6.75 or 6.625. There's always more to it. So the point is that you have to ask questions or work with professionals like people here at Council Mortgage that will actually go through all the options, because there's a lot of different things. Just thinking refinance is not necessarily the right answer until you actually go through the analysis.
A lot of people don't even think about how much principal they're taking off on their current first.
No, and this is why I kind of like the interest only loans, because you have control of the amortization schedule. So if you can get an interest only loan, meaning that your minimum payment is interest only. There are lenders that offer 30-year fixed mortgages where the first 10 years are interest only. Rates may be a little bit higher, but they're out there. But you have control over the amortization schedule, because when you get an interest only loan, they can only charge the amount of interest based on the outstanding principal. And if you keep paying down principal, that interest amount that they charge goes down and down and down and down, because you're in charge of the amortization schedule. So instead of maybe $600,000 of interest over 30 years, maybe you're only paying $300,000 or $400,000. There's another lender out there that's got a product that really intrigued me, but it's a good one. And for the right borrower, it'd be great, where it's a mortgage, but it operates like a checking account on your home. So what you have is you have this checking account that, let's say that your mortgage balance is $200,000. So you refinance, you have $200,000. Every time you make a deposit in that checking account, it pays down the mortgage. And every time you want to buy something, you write a check right off that mortgage too. But for people who have varying income and they get these big deposits, that may be something, because that type of loan, now those rates are a little bit higher, but it gives you such flexibility that you will pay off, for those borrowers, they'll pay off their mortgage in a lot quicker than a regular 30-year fixed mortgage. But these are just a couple examples of things that we know, that we've been doing this forever, that, would help you if you were considering refinancing.
No, John, when you were saying the interest only, there's no prepayment penalty on interest only loans when they're your primary residence.
That's right. That's right. That's right. Which is interesting, because this gets into my next topic, which is AI. Everybody loves AI, ChatGPT, Claude, Perplexity, Pilot, I think is Microsoft's. Everybody loves AI. But I think we just showed that AI can't replace judgment. A lot of people want to use AI for all sorts of things. Don't use it for your mortgage and for trying to decide on your mortgage. We just explained how, because AI cannot replace judgment. AI can't tell you that a refinance is better than a HELOC. We're going to have to do the numbers, and we're going to have to get your scenario. We're going to have to figure all that out. You could spit it into AI, but most of you who use AI know about the reliability of the responses to AI. It's not always reliable, is it? But sometimes it's interesting though, right? And it kind of helps you a little bit, helps you form some ideas, but it's not always reliable. AI can't tell you if an FHA loan or a conventional loan is best for you. AI can't tell you if you should go for a jumbo loan or do a conforming loan with a HELOC. AI can't tell you whether I should do a reverse mortgage. There's a lot of things AI can't tell you. And those are the things that we do here at Council Mortgage, is we help you try to find the right loan for your purposes. Why is it that you're getting a mortgage, and what is it? This is a conversation I have all the time. So what are you doing? I mean, I'll talk to people, because people who have wealth, they can borrow against their portfolios. And I say, I don't get the deal, but maybe you should consider borrowing against your portfolio. Maybe you get a better deal because you'll be paying yourself interest and pledge some assets. Maybe that works for you. Maybe it doesn't. But this is what we're involved in. We are in this business. This is what we do every single day. And so we know this. AI isn't going to replace us, and nor can it. Anybody want to comment on AI experiences? How many times have you researched something and it'll give you I've got a lawyer friend of mine who he said, just for the heck of it, I had this issue and I wanted to put it in AI. So I put it in. I was looking for a case that said this, and I said, it was perfect. It was exactly the case I said. So it gave me the case. I looked it up. Didn't stand for a proposition at all what the AI said. It was completely off. So AI isn't as reliable. It's interesting. It's fun. Some people, if they're writing a letter to somebody, they want to spit it through AI to help them with their language. Okay, that's cool. But there's caution with AI. Anybody else have anything else that
I think I mentioned this to you, John. An anecdote. I was reading the Bar Journal, the Arizona Bar Journal, and this lawyer responded to a summary judgment motion by using AI, illegal AI, and when you do that, you're supposed to cite cases that support your position.
Right.
Well, the citations that this legal AI gave him were all in error, and he never checked them out. And as a result, he was reprimanded for, sending in an incorrect response. So
Yeah,
you got to be careful.
Yeah, it's dangerous. It's definitely dangerous. No question about it. Anybody else on AI? Okay, another thing we're going to talk about
Alan's
today.
trying to say something, but we can't.
Oh, Alan, you have to turn on your microphone.
No, I was just saying the Ukrainians are using AI generated for their drones, and the drone will actually recognize a commercial vehicle between a commercial vehicle and a military vehicle and be able to pick which one they want to hit. So that's where the technology is really being advanced in AI. So
Okay, all right. Well, there you go. There you go.
Interesting.
yeah.
Okay. So the next topic today is credit scores. Lenders, what you may not know in the public is that there's different credit scores depending on what you're going to purchase. There are different algorithms. There's if you're purchasing, like a lot of people, they'll get their credit cards and they'll come up with a credit score. That doesn't apply in our world, in the residential or in the mortgage world. That it applies to if you're trying to get a credit card, maybe a car loan. But there's a different algorithm if you're going to get a residential mortgage loan. It's a different scoring system. And most of it's been FICO, but recently the lenders have allowed something called Vantage. So lenders now are using two different types of credit scores to approve loans. Some have adopted Vantage, many still have FICO. So here's a little article by Experian, which is one of the three credit bureaus, on FICO versus Vantage, because this is something that you're going to probably hear more and more about as we go on. And so here it is. Okay, VantageScore versus FICO. What's the difference? So here's a big table. Lender use, lenders are using it. There's different types of models. The credit score range is still between 300 and 850 for both generally. A mix of factors are used to determine credit. Minimum credit history required for a VantageScore, 1 month of credit history, a collection account, or a bankruptcy filing. For FICO, a credit account that's at least 6 months old and activity on a credit account within the last 6 months. So this gives you a little insight as to why they wanted to allow Vantage, because you don't have to have as much depth of credit history, and you may be able to get a Vantage credit score, which could allow you to get qualified for a mortgage loan. Treatment of collection accounts. Vantage, newer scores tend to ignore paid collection accounts and unpaid medical collection accounts. And FICO, newer scores tend to ignore paid collection accounts and unpaid medical collection accounts under $500. A little more restrictive with FICO than with Vantage. So those are the big differences. I bring it up today to let you know that you may, and I'm just kind of skimming through the article, scrolling through the article because you can see what it is. But you just type in Google Vantage versus FICO, and you'll be able to pull it up. But you now see that there's another way that lenders are looking to evaluate your credit. And when we pull credit scores here, we pull both. We pull Vantage and FICO. And there are differences in those scores, and which could also end up giving you a different interest rate too. Because remember, one of the things that's categories for interest rate is your credit score. So Vantage versus FICO, you're going to start seeing Vantage as another option for credit scores, and lenders are going to be using. And it's still a tri-merge. It's still Experian, Equifax, and TransUnion. They all have Vantage scores, or they could use FICO. So anyway, that's something that's new and something that you're going to be seeing.
Is there any effect on the cost of pulling?
They're roughly the same. Not much of a savings. Okay, guys, that is everything as far as market update, condos, refinancing, credit scores, AI. That's what we have today. If any of that stuff is of interest to you, if there's anything that you have questions about, let us know. We were encouraged by today's news that the Treasury is going to double up the purchases of Treasury bonds, because we may start seeing a little bit of relief in interest rates. If we do, you can certainly contact us, because we have our finger on the pulse of that. So if that's not it, that's all we have for our podcast today. The panelists are going to stay on, because every year we have to do anti-money laundering training, and that's exciting. And those panelists and us are going to stay on for that. But we don't need to involve you here on the YouTube channel. So thank you again for watching, and we'll see you next time. Thanks.